Mihir Vora, CIO of Trust Mutual Fund, joins in right now on the show to talk about his thoughts. Mihir, always a pleasure talking to you. Today is no different. Thanks for taking the time out. And Mihir, what's your sense? Are you a lot more constructive on the Indian markets than what you may have been when the first murmurs of these heightened tariffs started?
Absolutely. Hopefully, we are closer to the end of the crisis than further away compared to a couple of months ago. Uh, there have been reconciliatory sounds from both sides. President Trump has tweeted some softer tweets, and Prime Minister Modi has also immediately responded with positive acknowledgement of that. So I think. Probably we are coming around to some kind of agreement in the next few months. Having said that, the tariffs still remain in place. The pain at the industry level, still continues. So we hope that this issue gets solved sooner rather than later.
Okay. Mihir, beyond tariffs, what is your thought around how to look at the markets? Because there seems to be this whole strong move towards getting consumption going, right? So do capex plays take a back seat, or as some brokerages were saying yesterday, that maybe the valuations and the way they've come off discount some of this, and there might be a time to look at capex in your portfolio. How do you think about it?
So I think compared to say 1 year ago, where consumption was distinctly weak, both on the urban side as well as the rural side, probably more on the rural side 1 year ago. But after that, rural has started picking up, urban has probably started slowing down, and the budget tax cuts as well as the GST cuts in the last week will help domestic consumption for sure. So I think the portfolios or the strategy, which was very skewed towards the investment phase, the investments theme, compared to 6 months ago or 8 months ago, probably is now a little more balanced towards both consumption as well as the industrials or the investments theme. But having said that, structurally, I would say that if we have to grow at 7 or 8%, we cannot do away with the investments theme. So while the government GST cuts will help consumption in the shorter term, ultimately long-term consumption has to be driven by wealth creation, by job creation, by income levels rising, etc. And that will require a huge, continuing and huge investment in infrastructure, real estate, as well as manufacturing capacities. Because even if we say that there is no impact of tariffs on the services sector, the IT services, outsourcing, etc., they cannot create the 1 crore jobs that we need every year. We have to focus on construction, manufacturing, real estate, and infrastructure.
Mihir, hi, good morning. Tamanna here. Just trying to understand your view on why you think markets are responding so tepidly and such a mild response to the GST cuts, etc. Yes, there was maybe a sell on news kind of situation coming in. But if you think about it, GST cuts now have come in. The Fed might cut rates next week. You have a thawing of ties, and now tariff talks will continue between US and India. What is the primary concern to your mind that is holding markets back right now?
Primary concern is that, to achieve 6.5% GDP growth rate, we have to do all this. The fact that we had to cut GST rates, talk about reforms, etc., is an acknowledgement of the fact that there is a problem. The problem is that we are not on a 7% GDP growth rate trajectory. The tariffs, in fact, worsen the probability of us reaching there. So these are all mitigation steps rather than stimulus steps. So if we hadn't done this, the GST cuts, etc., then the situation would be worse. So we are countering the impact of the negative, but that does not mean that it's going to take us from the expected 6.5 to 7.5. This will make sure that at least we remain at 6.5 rather than slipping to 5.5 or 6. So that's what the market is, discounting. We did see a good run up before the cut. So obviously there was some hope and anticipation building up. So it's only natural that after the actual announcement happens, there will be some profit booking. But the core of the matter is that US economy is likely to slow down. The global growth is likely to slow down. and the central banks, of course, will do whatever is necessary after that. But even India was, slowing down and not probably likely to do 6.5 if we hadn't done all these measures. So I think the markets have reacted positively. From the bottom, we have gone up, but that only take care of the negative. It doesn't take us from a 6.5 to 7 or 7.5 GDP growth rate.
Very,
That's
very,
what the
yeah, very, very well put and explained, Mihir, and solves some of that mystery as well. Markets are expecting more. Where is that more going to come from in your view? Is it going to be in the second quarter if companies actually deliver on what is being anticipated?
Absolutely. So hopefully the busy season, the festive season should bring good news on the consumption front. So that probably help the markets. The key variable that I would be looking for is credit growth, which has not really happened. Because once credit growth starts showing up, it actually means that corporates and households are now to some extent unleashing the animal spirits. So that's one very important factor to watch. So far, we haven't seen good traction in credit growth, which is a bit of an issue.
Mihir, would the markets look forth to two or three crucial things? Anticipation of more reforms, and the market may want to believe that the GST was the first true blue start on the move of reforms, and there could be more deregulation, etc. And anticipate a good second half led by the GST-led consumption uptick in the third quarter. And therefore, would the markets, independent of the tariff pressures, have a fighting chance of being higher than where they are right now, a couple of months or 3 months down the line? I know I'm asking you to comment on a short-term thing, but these days, sometimes years get compressed into months, and this is probably one of those times.
Certainly. So my core belief is that we should start redefining what the market is. In the sense, if you're looking at the Nifty 50, then you probably are not looking at a huge upside. The real action and the real, I would say, granular growth is happening in the broader market, in the broader smaller industries, mid caps as well as small caps, and of course the unlisted space. So, as I said, there were so many conferences. You also were there in a few of them. If you meet individual companies, especially the mid and small caps, there is a huge amount of action happening. So I think instead of talking about the market, which is the Nifty 50, we probably should focus more on the wider market, which is the NSE 500 or the mid and small cap indices, because that's where the higher growth is. Just to give you an example, the Nifty growth rate or the NSE 500 overall growth rate, probably in terms of profit growth, will be about high single digits for the next couple of years. But if you look at the mid cap index or some of the small cap names, there are so many stocks which are growing profits at 20% compounded, 25% compounded, so on and so forth. So that's where the stock picking opportunities are. In fact, if I look at some of our small cap portfolios, the aggregate weighted average earnings growth rate for the portfolio would be in excess of 25-30%, So that's where the scope for stock picking is. So while of course we want the Nifty to go up, but given that it is large cap dominated, especially dominated by banking and IT, it means that the stellar earning growth potential is lesser. We need to look at the broader market.
So here, I mean, this was technically the conference season. Not that you need a conference to reach out to companies with your size, but still, you would have attended these, met managements one-on-one, in groups, etc. What conversations impress you the most? Which themes look poised for a near and a midterm earnings growth momentum that could help them outperform, according to you?
I think the manufacturing space in the mid and SME space is I think doing a lot across the segments. I would say if you look at pharma companies, chemical companies, auto ancillaries, some of the smaller capital good manufacturers, etc. EMS, electronic manufacturing, and the ancillaries to EMS. A lot of these PLI linked segments, I would say, are showing traction. And given the seriousness and the success that the government has tasted on the production linked manufacturing theme, I think more and more sectors will come into PLI. Government is open to rolling out more incentives. So whether it's broadly speaking, I would say a lot of action on the manufacturing side.
You know, I'm just wondering, Mihir, what are you finding that is exciting from a 6 months perspective right now? Once we have maybe a clearer picture on growth, tariff tensions behind us in a decisive fashion, what would be the areas that you see some kind of an up move and are exciting you?
As I said, consumption versus investments, now we are more balanced. So we are more, in favor of consumption compared to earlier. But investments and capex manufacturing theme do continue to play a prominent role in our portfolio. So we are over it on both these segments. I think apart from capex, which includes themes like capital goods, defense, other manufacturing, chemicals, etc. Those will continue to do well. Pharmaceuticals also in terms of manufacturing, CDMO players, etc. should do well. But consumption, of course, will get a shorter term boost. But the main, if I were to look at the main driver, which I would hope comes sooner rather than later, as I mentioned earlier also, is the financials sector. Financials has a large weightage in the broader indices, especially the large cap indices. And there, the problem has not been so much on asset quality or capital adequacy, etc. There, the problem has been on the credit growth. So that's one sector which offers a lot of value. It has underperformed. Valuations are not a problem. There's no issue on balance sheet quality, etc. Just one trigger is required, which is that of credit growth. That's what I would hope will create extra alpha in the next 6 months. Though as of now, we are not usually underweight on that. But when credit growth happens, that's the first sector I would like to go overweight on incrementally.
Wow. Okay. We'll watch out for that. Mihir Vora, such a pleasure talking to you today. Thanks for the clarity of thought. Really appreciate your time.